Welcome to session 10 of the Rebel Income coaching program. In this session, we're going to dive into some more detailed aspects of understanding how to set up and keep track of a successful trading system. We're going to talk about how calculating success rates gives you a way to think about whether your trades are working the way that you intended, beyond simply looking at your account balance. We'll also talk about trading frequency and the ways that increasing your trading frequency improves the power of your income generating trades, along with the impact it has on your approach to trade and account management. While I follow a very specific structure for the way that I identify the trading opportunities that I publish in the Rebel Income blog and apply generally conservative principles to the way those trades are placed and managed, the fact is there are also other ways to use the same stocks for practical income generation that won't match the approach I use. We'll talk about some of the ways to think about some of those modifications on the trades you see me write about and place for Rebel Income. We'll also revisit some of the position sizing principles we covered in session 9 and talk about ways you can vary your approach to position sizing in a practical sense to minimize your larger portfolio risk while also leveraging a stock's downward trend, including opportunities to work with covered calls in those stocks to help you minimize your net cost basis and make staying in a stock for a longer period easier and more practical. One of the things that naturally attracts traders to the options market is the leverage nature of option contracts. The idea that you can get more bang for your buck by trading options that you would get by trading the stock itself. That's technically true, but in my experience, it's also a mixed bag simply because any momentum or swing-based directional trading system is always wrong more often than it's right. My own trades along these lines have taught me that I can expect to have just about a 25% success rate when my focus is directional in nature. That's why I prefer to be an option seller rather than an option buyer. It's definitely possible to make money with directional option trades, and when you do hit a winner, it's usually a big one. You may very well be able to double the money you put into a trade in just a few days if you can time it right, and that can happen in options with just a few dollars of relative movement from the underlying stock. Sounds great, right? Until you consider the reality that leverage cuts both ways. If you aren't right about the stock's direction, that option's leveraged nature, along with limited time value, can quickly work against you and erode the value of the contract right in front of your eyes. Now, add to your calculation the chances that you are going to be wrong 70 to 75% of the time. This reality and the difficulty it imposes on profitable trading over time is the primary reason that years ago I shifted my focus away from strictly directional options trading, being the option buyer, and began to focus more on income generation by selling options premiums. The part where people tend to get a little confused comes when they find out not only that all of the upside in the put selling income driven trades I place with the Rebel Income system is in the premium I get when I place the trade. Also, that my objective is to average a total yield of about 1.5% per month. Why should I settle for so little when I can do so much better with those big bang double your money directional trades? My first answer always goes back to probabilities. Yes, I can always double my money from time to time with a good long call or a long put trade. But if my chances of being right about the direction a stock is going to go when I place those trades is only about 1 out of every 4 trades, then the chances that I'll double my money in any one of those winners is probably only about 50% at best. When I lose, I usually lose about 30 to 50% of the capital I put into the trade, which makes the long-term success of that system even more difficult. It's one of the biggest reasons I've seen so many people start trading options with great excitement, but eventually get discouraged and call it quits. The chances of success, and this is where success rates comes into play. The chances of success with put selling, on the other hand, as I like to use it in Rebel Income, is much higher. You see the results for yourself, or you can see the results for yourself in my trading log, which as of this writing covers almost 10 years of trading activity. My success rates in these trades, meaning that the position was ultimately closed sooner or later with a net gain, is a little over 97%. Taking a 97% win rate or success rate versus a 70 to 75% losing rate seems like a no-brainer in my book. And if that means that I have to settle for a 1.5% return rate per month on average, then I'm fine with that. You can go ahead and count me in. My objective is not to beat the S&P 500 in years like 2019 when the stock market goes up 25, 30, 40%. But that really isn't what I'm trying to do. I'm just trying to generate useful income on a consistent, steady basis to provide a measured, high probability path to long-term success. I think put selling, as we do it with the Rebel Income system, works no matter whether your objective is to use the income or to build long-term wealth over time. If you think about it, you can generate 1.5% return per month, month after month. If you're excuse me, let me back up. If you can generate 1.5% return per month, month after month, you're going to bring in about 18% in annualized returns per year. If you repeat that process year after year, you see a terrific recipe for long-term success. Now, when we're talking about success rates, what this does then is it allows you to put all of these trades in a much different and broader excuse me, much broader overall context. How often you place winning trades versus losing trades. So you're able to think about things from a historical perspective, put your winning trades and your losing trades into context, and consider what kind of adjustments might be appropriate for your trading system. The math for calculating success rates is actually very straightforward. All you do is take the number of winning trades and divide it by the total number of trades that you've placed. Let me demonstrate some of the elements here related to how this works. The page that we're looking at right now is a summary page for my trading log. On this page, I try to keep track of a lot of historical data about my trading system. The success rate that I show here, we call that win-loss for simplicity purposes. As of the end of March, this rate was almost 97.6%. Now that means that out of 100 trades, I have approximately 97, not quite 98, close successfully, close it with a winning overall result. The other element here, and you can as a member of the Rebel Income blog, you have access to my track record, which you can see here. This is where I keep track of it, but this is also published in the blog for you to be able to access at any time, so that you can see my trades as I place them from week to week. Another interesting and useful element on this page is the average gain. This is where I calculate the overall average gain of all of the successive closed trades that I've had. And this provides a good way to calculate what the overall success of the system is. Am I meeting the 1.5% per month target that I've set, or does that need to be adjusted? Average days also gives me an idea to the amount of time that I typically in a trade. As you've seen me write about explain in earlier sessions, I'm generally trying to work with expirations of 30 days or less, and so this gives me a good feel for where that sits. Average loss is also really interesting in this case. Remember that when we're talking about probabilities of success or failure, if you have a 2.48% average gain against an almost 18% average loss, your initial assumption may be that I'm losing far more often. I'm losing a lot more money than I'm making, but the math will indicate otherwise. Let's consider this. Well, let's just work on the basis of 100 trades, and I'll round my numbers down for purposes of simplicity. We'll assume that out of 100 trades, I'm going to place 97 winners with an average gain of 2.48%. That means on these winning trades, I will have seen a total net return of a little over 240%. In other words, a little more than tripling my money in those trades. On the other hand, I have an average of an almost 18% loss on my 3 losing trades. So I'm going to go ahead and round up to 18. And that means that I have an average loss of 54% against an overall net gain on my winning trades of 240%. The overall net result is a little bit less than 200%, but that is more than acceptable. And this is why one of the things that becomes really, really useful in thinking about success rates is also considering how much you're making when you win versus how much you lose when you lose. Let's flip the script for a moment and suppose that out of 100 trades, you are wrong 70% of the time. So we're going to assume a 30% success rate. Let me pull up a document and let's simplify this just a little bit. So that I can demonstrate it a little bit more effectively. Let's say that we're talking about a typical directional trading system. Success rate is 30%. Which also means that the system loses 70% of the time. The average gain when we win, we'll just go ahead and say that the average gain is 50% on those winning trades. For the sake of argument, we'll say that when you do have a winning trade, you usually do very, very well. And then we'll say that on the average loss, we'll put that at the same 50%. So the average percentage gain on winning trades is we're going to go 0.3 times 50. So an average gain is the total percentage gain is going to work out to 15%. On the other hand, total percentage loss on the 70 losing trades .7 times 50 it's minus 35%. What you see then is a very stark difference between how much money you're able to make when you win versus how much you lose when you lose. You think about a 35% net loss in your account over the course of 70% losing trades, and you're only making 15% overall when you win 30% of the time. You can see where the directional trading becomes far more difficult and far more difficult to maintain over any kind of extended period of time. This is why the overall win-loss rate that I have with Rebel Income becomes so much more important. And when I can flip the probabilities to where I am winning more often than I'm losing, I can accept much lower individual average gains on my trades. Okay, so that's the directional trading success rates versus Rebel Income. All right. Another element that I get asked about why I tend to use such another element I tend to get asked about is why I tend to use short expirations when I sell options. Over the years, as I've evaluated some of not only my own investing systems, but also those of other traders that I know and people that I respect, I've seen many of them sell options, especially income traders sell options out for as long as a year because they bought into the logic they'd get a fatter immediate payoff by selling more time by making only a few trades per year. Just a moment. So as I mentioned, I've talked to a lot of traders and seen many of them sell options out for much longer periods than monthly, because they bought into the logic they'd get a fatter immediate payoff by selling more time by making only a few trades per year. This is a mindset that frustrates me a little bit, because it seems a little bit like tripping over dollars to pick up pennies. The truth is that even though selling shorter periods of time give you smaller immediate premiums, the cumulative effect of those smaller, more frequent payments give you significantly bigger returns in the long run. Let's take a look at what I mean. So on this table, I'm showing a relatively small account balance for purposes of simplicity, but it is easy to see what kind of a difference making more trades over smaller periods of time produces. So in each case, what I've done is I've shown the average, the return percentage for each different, at different levels, 1.5%, 2%, 2.5%, with the trading frequency varying from once a month to every 3 weeks to every 2 weeks. You can see it's very clear at each level, 1.5%, 2%, or 2.5%, that in each case, making more trades over smaller periods of time produces superior results. This is an important distinction to make and to understand. One of the criticisms I used to see was that you incur more commissions by trading more frequently, but in today's day and age, majority of online discount brokers now operate with either no commission trades or option trades with commissions of less than $1 per trade. So commissions really don't matter. In any event, this makes sense. Look at this with 1.5% every 3 weeks and 1.5% every 2 weeks versus once a month. You see a difference simply just over a period of, by placing trades every 2 weeks. You see a difference here at 1.5% of a difference of almost $2,000. At 2%, the difference is almost $3,000 in account growth. This is out over 12 months on just a very, very small trading account. Here's the difference at 2.5%, about $3,500. So these really provide a lot of evidence in my mind that shorter expirations produce better results in the long term. Now, if you've been following my trades for a while, or as you follow the Rebel Income system, you will find that the numbers that I'm showing here are very reasonable. They're very possible because we've seen a lot of stocks in that time provide exactly these kinds of opportunities over the time periods that I'm covering. The other reason for using shorter expirations goes back to probabilities and is tied very closely with time decay. Remember that when you buy options, time is working against you. Every single day, some of the time value of the contract erodes. And if the stock doesn't move the way you need, you will also lose equity value. It's a double whammy that accelerates losses and makes the low probability of success that much harder to overcome. That's the 15% net overall gain over 30% success rate versus losing 35% on a net basis over the course of 70 losing trades that we demonstrated. On the other hand, selling options puts time on your side because we're selling very short periods of time, which means that you actually want that time decay to occur. Sellers take advantage of time decay, whereas time decay works against option buyers. If the stock is above the strike price you sold, this is why I always sell out of the money, there is no equity value in the contract, which means that it's almost all tied to the time in the trade. If you follow the logic that in the long term stocks tend to go up more than they go down, then it follows that in the short term prices will remain more volatile. That assumed volatility, which for option traders is called implied volatility, which we talked about in the Option Greeks section of this coaching program, is part of what makes the premiums for short-term options attractive for the sellers. It also follows that selling shorter periods of time increases the chances that the stock won't finish below the strike price that I sold, which then opens up the opportunity to repeat the process again the next week, which activates the compounding effect the table above illustrates. If I have trades that expire every 30 days, and I'm averaging 1.5% return on those trades, then my expectation should be something, excuse me. Sorry, I need to get to the screen I wanted, I apologize. I'm working with 1.5% average returns on my income trades, but I'm only able to recycle them every 30 days. Then this is about what my expectation is. But if I can shorten that by 2 weeks, you can see that I'll get a much bigger result. And again, that follows here and here, as well as here and here. Okay. Let's talk for a minute about the difference between, we talked about trading frequency. Let's talk about passive versus active income generation. There is a general difference here between what I call passive versus active income investing. Rebel Income, our normal method is to, when you see me highlight a trade, I'm going to hold that put sell or that covered call all the way to expiration, meaning that whatever happens at expiration is what I'm going to accept. If I'm assigned the stock from the put sell, I'll go ahead and accept that assignment. If I am called out of a covered call, then I'm going to go ahead and be okay with that. I don't avoid put sell assignments, and the average trade duration, as I demonstrated, is a little over 19 days in these trades. I call this passive, not necessarily because I'm not paying attention, because I do pay attention to these trades on a daily basis, but I am not trying to actively manage each put selling trade position before expiration. Some of the people in our group have been able to do really well by taking a little bit more active approach than what I am demonstrating. And this is a method that you'll hear me talk about, which is called trade. I like to call rolling a trade. What this means is that instead of being willing to wait for the option to waiting for the expiration date on the option to come, more active traders may choose instead to pay very close attention to a stock's price movement on a daily basis. And if they can see the stock moving strongly against the put selling position, they may choose to simply buy it back from the market. Now that means, remember that you always sell at the bid. That means that they're going to go out, they're going to go into their brokerage account, put in a buy to close order based on the most recent asking price. And then they're going to try to go ahead and close out that expiration. Once you buy back a put sale, the obligation of being assigned is eliminated, even if that happens on the day of expiration. Some of our more active traders may do this 2 or 3 times in the same process, in the same amount of time that I place a single put selling trade. You can also apply this not only if the stock is moving against you, but also if it is moving strongly in your favor. Let's say that I sell a put option at $40, and within just a few days the stock has moved up to 43. If I brought in $1 in premium on that put sale, then after seeing the stock move so sharply in just a matter of a few days, that option may be now available with an asking price of 50 cents per share. That means that a more active trader, a more active income trader, may choose to go ahead and buy that option back, eliminate the possibility of seeing the stock reverse back against that trade as quickly as it went up, and they will still be able to hang on to a 50-cent net gain in the overall 50-cent net gain overall in the net trade. They're also then the same capital that they used for the original trade then becomes available immediately to be able to place another trade, whether in the same stock or in something else. So by doing this, remember what I said about trading frequency. I'll demonstrate this a little bit more in just a bit, but this allows them to accelerate the compounding effect that trading frequency gives you. One of the primary intentions then is to avoid put sale assignments. If you want to take a more active approach and to be a more active roller, as it were. All right. Let's talk about position sizing, working with tiers. Now, in the previous session, when we were talking about position sizing, I recommended that you should have no more than about 3 to 5% of your total capital in a trade at any given one time. What that means is that not only that you're going to limit the overall size, but in my example account that I demonstrated in that session of $250,000, if I'm working with a 3% maximum position size, then the maximum number of dollars that I can put into any one trade is about $7,500. The idea behind working with a tiering system is that I may be able to break up that $7,500 into 2, 3, possibly even more trades, depending on the stock's price and what the overall price movement is like. This provides you an opportunity to work with stocks in a downward trend in a way that you're not able to do if you put the entire amount of capital allocation into the trade right up front. Let me show you an example. Just a moment. This is Walgreens Boots Alliance, WBA. This is a stock that I was assigned some time ago at around $50 per share, and I'm still holding. Just a moment, let me find it. Here it is. I was assigned about a year and a half ago at $49, and I've watched the stock continue to stay below that $49 price ever since. The stock, as of this writing, or excuse me, as of this recording, I should say, is at about $32.50 per share. It is showing some bullish momentum right now, but it is still significantly below that original $49 put sale assignment. Now, with that trade, I put all of the capital that I was willing to put into the trade into it all at once. I did one contract given the size of the account at the time. Let's work with a little bit larger example account. Let's go with $500,000. This tiering system honestly does work a little bit better with larger account sizes. But here we go. If we're working with $500,000, I use the same 3% threshold, that I'm about $15,000 per trade. With WBA on this put sale that I was assigned at $49, that means that I could have used up to, I could have sold up to 3 contracts on the initial put sale if I had wanted to. What tiering would allow me to do then is to break that possibly into at least three different pieces. If I divide the 15,000 by 4,900, we can see I get a little over 3. I'm going to round down to just 3 basic tiers. I could do $5,000 per trade in that case. Now consider the overall downward trend and what this allows you to do. I was assigned this stock in February of 2022. Let me grab my pen really quickly. At $49. So as it was about here and dropping. Let's suppose that after I had been watching it drop down to here in July of 2022, the stock was down at around 36. I'm going to go ahead and say, and starting to pick up a little bit of bullish momentum. If I had wanted to at this point, and I had set up a plan to tier into my position, start with a smaller position initially, with the possibility of being able to buy in later, then at this point I could sell another put sale with perhaps a strike price of $36. I'm just going to go ahead and put 36 here. We'll assume we watch the stock go up and then fall back down again. And so there's another assignment that took place here for the sake of my example at about $36. So these circles are assignments. What this does, one of the immediate things and advantages this gives is that it starts to help me lower my average cost in the stock. If my initial put sale was assigned to me at 49, my second put sale was assigned to me at 36. That means that my average cost is $42.50, which means that when the stock is here at $36 per share, it's a little bit easier to look at and think about logically and rationally being only $6 away from my average cost than being $13 away from my initial cost. Now let's suppose that I did it again. I applied another trade a little bit later after the stock had gone down some more. I watched it go down, I watched it come back up here, and now it's come back down to, well, let me come back down here, and let's suppose that I sold another put option at around with about a $31 strike price while the stock was up in this range. Then I was assigned here. Stock was at 30, I was assigned at 31. For the sake of our example. Now I have that third leg, that third tier in my position size. So now I have 49 plus 36 plus 32. When I divide that by 3, now I have a net average cost of $39 per share. Again, this changes the evaluation process and makes it a little bit easier to think about staying in the stock on a long-term basis, as long as the fundamentals are still solid, as long as the value proposition is still solid. As this one stands, I am in this trade at $49. That is my entire allowable position size, and that's fine. I still like Walgreens, and I do believe that the value proposition is much higher than where the stock's current price and downward trend have shown it to be. And it pays a healthy, attractive dividend. And for the time being, I'm willing to go ahead and continue to be patient and wait for it to arrive, to move back up to my original assignment price. The other thing that we can do, besides working with tiers, which is always useful, or I should say always can be useful, is to think about placing covered calls on a stock within a downward trend. Now this requires a different trading approach and mindset than the passive approach, where I set my place my trade and I wait until expiration to see what happens. And the reason this would be true is because you would be selling a covered call at with a much lower strike price than the price you bought the stock at. The purpose in doing this is to try to leverage the power of lowering your net cost basis with successive covered calls in a downward trend, which can be very, very useful and functional. But it also requires that you are on top of that, on top of those trades on a much more frequent basis. So let's go to an actual example here. Here's Walgreens Boots Alliance. Pull up the option chain. Let's go out a little bit further. Let's take a look at 11 days to expiration. Stock is at 32.67. As we mentioned, it's picking up some bullish momentum. So there's some interesting opportunities here. Let's say that we wanted to work with the 33.50 strike price. It's about $1 away from the stock's current price, so it's still a little bit above. And it's got a premium here of 66 cents for about 11 days of time. Against my $49 strike price purchase, which is what I bought the shares at, that's about 1.34% for 11 days. That's actually fairly attractive. Now, as long as the stock does not drive above 33.50 within the next 11 days, then this covered call will expire worthless. The 66 cents remains in my account, and I can count that 66 cents against my overall cost basis of $49. And then I can go and I can decide whether or not I want to place another trade. The caveat is that if the stock does pick up momentum and its bullish momentum continues and it pushes above 33.50 before expiration, I am now at risk of being called out of that trade at a much lower price than the $49 I paid, which would mean that my plan, I would want to make sure that I set a specific intent of looking for an opportunity to buy that call option back from the market as soon as, or if the stock pushes above that 33.50 strike price that I've sold. If you want to be more conservative, then you can sell further out of the money. In these cases, I would strongly recommend against selling close to at the money or in the money with these covered calls, simply because of that risk of being called out. And in any event, you should plan on trying to be very, very nimble about responding to price movements where the stock accelerates quickly against that covered call position. The reason I'm bringing this up and I'm pointing this out is that many of the other members of our group have been able to have very, very nice demonstrable results with stocks in downward trends and selling covered calls. The downward trend that we have with Walgreens is a really, really good example of how this can work in your favor. Let me pull up my pen again. I was assigned in February at about $49, as I mentioned, so here we are. I could have possibly taken an opportunity up here when it was where it was plateauing a little bit to sell a covered call, covered call 1, and let's say, just for the sake of argument, I brought in 50 cents, so about 5% for maybe 2 weeks of time, a little over 1%. The stock dropped, rose up again, but stayed down, which meant that this would have expired. Then I might have sold another covered call here with the stock down around at 44. Covered call 2. And we'll say that again, just for the sake of argument, I brought in 50 cents again. Stock went down, expired. And then I sold another one here. We'll go ahead and say this is covered call 3. Again, about 50 cents. And we'll say that was at about $39. Well, here we see the stock rally very strongly back up again. Looks like it's going to possibly reverse this trend. At the point where it breaks above this line at around $39, this would have been the signal to buy it back. I would probably have had to pay more than 50 cents to buy this option back at that point. Let's say that on the buyback, for the sake of argument, I had to pay $1. So I have 50 cents, 50 cents, 50 cents, $1.50. Overall, then I still have a net gain in my covered calls of 50 cents. So I buy that back, I close it out, and let's say I sell right away another covered call as it's picking up momentum here. Here's covered call 4, and I bring in another 50 cents. As it's continuing to drop. That expires. Maybe I do it again here. This will be covered call 5. Here's another 50 cents. And it rebounds again. I'm going to need to buy that back. For the sake of our example, we'll stick with the $1. Watch the stock go up again, and then when it hits here, plateaus again at about 42. Here's covered call 6. We'll go ahead and again stick with our 50 cents. I'm obviously simplifying these numbers for the sake of the example. So stock drops, that expires. Say I sell another one at around 36. Covered call 7. Again, about 50 cents. Drops, expires, stock rebounds a little bit, but then plateaus again. Let's say that here's where covered call 8 happened. And again, brought in 50 cents. Now, what I have is a total of 8 trades, income generating trades, where I've been able to bring in 50 cents per trade. Which means I've been able to bring in $4 in premium. I had 2 trades that I would have had to buy back before expiration in this example to avoid getting called out below my $49 strike price. So I had to pay about $2 to do that. But that means that I was also able to hang on to $2 against of that income. That is $2 that I can count against my $49 assignment price. So that automatically lowers my my net cost from $49 to $47. That's even if I put in the entire amount of I'm willing to allocate for that trade right away. I can still apply this this approach to covered calls to try to lower that cost basis even more. You can also combine this approach with this tiering system that I covered earlier, if you prefer, so that you get the average, you get the advantage of averaging your net cost down along with the compounding impact on lowering your net cost basis that the covered calls give you as well. We've seen a number of members of our group use both of these strategies together and separately to very nice effect in their positions. These are strategies you won't see me apply because I do take a little bit more passive approach, as I mentioned. When I sell covered calls, I prefer it to be at the strike price that I was assigned for purposes of simplicity, so that I can simply set the trade and not have to worry about managing it day by day during the day while the market is open. It fits better into the way that I need to manage the Rebel Income blog, as well as the other requirements within my account and frankly my personal life. So remember, this is also always about trying to develop a system that fits within your lifestyle and that takes the amount of time that you can afford to give to it. If you ever find that your trading system is taking more time than you prefer or than you can reasonably dedicate to it, then it's probably a good time to go ahead and think about maybe redoing some of those rules. But the principles that we've covered in these last two sessions should give you a good basis to start thinking about some of the different components of trade management you need to think about in order to be successful with your income generating system. Thanks for your time. I hope you found this useful, and we'll see you in. I will see you in the Rebel Income webinar, and with the trades that I publish on the Rebel Income blog. Thank you.